Howdy, everybody. Welcome to Liberty Call for January 27th, 2025. Hope everybody's having a fantastical Monday out there in the interwebs. Pretty nice day here in Colorado. It's not freezing, which is always nice. And I think the temperature probably up in the 40s or 50s. And the sun's out. Yay! So hope everybody out there had a fantastical weekend. And all right, well, let's start looking at the markets. They are in turmoil as NVIDIA takes a record $465 billion hit after China's new AI model shakes up the tech landscape. Meanwhile, AT&T is bucking the trend with a 70% profit surge, pushing its stock to a multi-year high. Investors are still betting on Chinese government bonds, despite warnings of an economic slowdown. And the UK wealth manager Evelyn Partners is offloading its fund solutions business. Over in Ireland, cost of living adjustments are hitting consumers with higher beer prices and energy credits on the way. Oh. Want any sober Irish people, they get really angry. All right, well, before we jump in and break it all down, I need some help from you. Could you give me some thumbs up, a like, share, subscribe, a follow, and press the notification bell? All right, let's hop into the markets for the day. All right, Dow Jones was up 0.65%, started the day in the red, was up 289 points, closed at 44,713. S&P 500 down 1.43%, 87 points, closed at 6013. NASDAQ down 3.07%, 612 points, closed at 19,341. And again, today is very similar to the days we've seen late last year and then, into this year where, the Dow, which is your blue chips, fairly strong, holding its position. The NASDAQ, which is very tech heavy, growth, your growth stocks, not doing well, doing very poorly. And then the S&P, in the middle. And, it's been the converse on a lot of days where you've had the NASDAQ where, it's up 3%. The S&P is somewhere in the middle, and then the Dow Jones is flat or in the red. So certainly not unusual. The VIX today was up 20.94%. There was a lot of headlines last night that were headed towards a major black swan event. The VIX is at 1796 right now. Canada down 0.7, Brazil up 1.8, and Mexico up 0.46. In Europe, Germany was down 0.54%. The UK. France down. The UK up 0.02, France down 0.27. Boy, crossing up my lines here. Netherlands down 0.72%, Spain down 0.15%, Italy down 0.03%, Switzerland up 1.2%, and Portugal down 0.57%. In Russia, both exchanges were red. MOEX down 1.95%, RTSI down 0.81%. And the overnight markets, the Nikkei in Japan was down 0.83%, Australia up 0.36%, New Zealand down 0.46%, China, the Shanghai was down 0.06%, Shenzhen Component down 1 1/3, China A50 up 0.07%, DJ Shanghai down 0.27%, Hang Seng 0, Taiwan weighted up 0.97%. All right, so those are the markets for today. I know I feel smarter. All righty, let's jump into the weekly economic update and see what my ghostwriters had to say for the week. All right. Stocks rallied last week as investors reacted positively to a handful of better than expected corporate earnings reports and developments out of DC. The S&P 500 gained 1.74%. The NASDAQ added 1.65%. The Dow Jones Industrial Average rose 2.15%. And overseas markets added 3.03%. A flurry of news. Markets surged over the first three trading days as investors cheered a flurry of new policy announcements and executive orders following Monday's inauguration. For example, investors responded to the news that the White House trade team is considering taking a softer stance on tariffs. It was also a good week for Q4 company reports and other upbeat corporate news. Markets leveled off on Friday as investors were disappointed that existing home sales fell to a 30-year low. But for the week, the NASDAQ had closed above 20,000 on 2 of the 4 trading days, and the S&P 500 closed above 6,000 at every session. All right, a look forward. The stock market is a discounting mechanism, meaning today's stock prices reflect all available information, including present and potential future events. And for the most part, the markets reacted positively to the news coming out of Washington last week. Some news spurred broad-based market moves, while other news had a more sector-specific impacts. For example, on Thursday, markets reacted positively to news that the White House believes interest rates were too high. No, they weren't. and wants to see rates trend lower. The Fed's first scheduled two-day policy meeting ends on Wednesday, so investors may be looking to see if Fed Chair Jerome Powell addresses the new administration's concerns. Chairman Powell should tell the administration to pound sand because inflation is still terrible. We've had no deflation anywhere, zero. I can't find any. So, all right. Key economic data this week. Monday's new home sales. We'll go through that report in a little bit. Tuesday, durable goods, consumer confidence, the Case-Shiller Home Price Index, and the Federal Open Market Committee meeting day one. Wednesday, the FOMC meeting day 2, U.S. trade balance in goods, retail, sale, and wholesale investments, and the FOMC announcement and Fed Chair Powell press conference, which I would put a solid $1 bill that they will not do anything to interest rates. Anyone who wants in on that action, send me an email or give me a call. Thursday, we have GDP, gross domestic product, pending home sales, and weekly jobless claims. Friday, personal consumption and expenditures index, employment cost index, and Fed Governor Michelle Bowman is speaking. Companies reporting earnings this week. Whew, that's a lot. Monday, AT&T. Tuesday, somebody forgot to make that bold. Starbucks, the Boeing Company, RTX, Stryker Corporation, Lockheed Martin, and General Motors. Wednesday, Microsoft, Meta, Tesla, T-Mobile, ServiceNow, IBM, and ADP. Thursday, Apple, Visa, MasterCard, Thermo Fisher Scientific, Caterpillar, Comcast, Blackstone Group, United Parcel Service, Marsh & McLennan, and Intel. Friday is ExxonMobil, AbbVie, and Chevron. That is the weekly economic update. Tongue-tied today. All right, well, let's get into the market recap for today. SP 500 slumps as tech in free fall on China AI threat. Dun, dun, dun. All right, the SP 500 fell sharply on Monday, driven by concerns over Chinese AI startup DeepSeek's potential threat to U.S. AI dominance. At midday, the SP 500 was down 1.8%, with the NASDAQ composite down 3.3%, and the Dow had only gained 0.3 at the time. Market volatility surged with the CBOE volatility index spiking 25%. DeepSeek's latest AI model, R1, is reported to rival leading U.S. models such as OpenAI's ChatGPT at a significantly lower cost, putting pressure on the AI-focused companies. NVIDIA saw a steep 12% decline, with other major AI-related stocks, including Broadcom, AMD, Microsoft, and Palantir, also experiencing substantial losses. Even power companies such as Vistra Energy and Constellation Energy, which had benefited from AI-driven energy demand, saw their shares tumble. Analysts at Vital Knowledge warned that DeepSeek could weaken AI market confidence, though Wedbush downplayed the threat, calling the sell-off a buying opportunity. Investor sentiment was further rattled by President Trump's tariff threats after Colombia initially refused to accept deportation flights. Trump threatened economic sanctions. Although Colombia later relented, the incident served as a reminder of the administration's aggressive trade stance, with potential trade tariffs with Mexico, Canada, and China, and the EU looming on February 1st. On the earnings front, attention is focused on upcoming reports from major tech firms, including Meta, Apple, Microsoft, and Tesla. Thus far, 80% of S&P 500 companies reporting have exceeded earnings expectations, while 62% have beaten revenue estimates. Additionally, investors are closely watching the Federal Reserve's upcoming policy meeting, where rates are expected to remain unchanged. However, focus will be on signals regarding future cuts. Key inflation data and GDP estimates are also set to be released this week. Awesome. Good stuff. All right, well, let's dive into some of the data. December new home sales. This comes to us via First Trust. Mr. Bryce Gill wrote this report. So let's see what it says. All right, new home sales continued their recovery in December, marking the second consecutive monthly gain and closing out 2024 on a positive note. Sales reached 682,000 homes, reflecting a 2.4% increase from 2023. This marks the second year of growth, although sales remain below the pandemic era highs. Looking ahead to 2025, the upward trend is expected to continue despite ongoing challenges in the housing market. A key challenge remains elevated mortgage rates, which, after briefly declining following the Federal Reserve's September rate cut, have climbed back above 7%, potentially dampening affordability. And I saw a headline on the news earlier that They'd actually gone back below 7% briefly today, so we'll see if that trend continues. However, prospective buyers can find relief in declining prices. The median new home price is down 7.2% from its October 22 peak, offering more affordability options. Additionally, median square footage has declined by 6% from Q3 of 2022 to Q3 of 2024, suggesting that developers are offering smaller, lower price homes to attract buyers. Inventory levels have improved significantly, while with the supply of completed single-family homes surging by 280% since the 2022 low. This contrasts with the existing home market, where inventory remains tight as homeowners cling to their lower fixed-rate mortgages. Despite uncertainties surrounding the future financing costs, the combination of lower prices and increased supply should continue to support new home sales this year. Awesome. All right. Next up, from Zero Hedge, is Cheap AI a Black Swan event? This was written by Peter Cheer of Academy Securities. The discussion surrounding market risks in 2025 has been dominated by Black Swan events, but gray rhino threats, that's a newer one, highly probable and impactful yet often ignored, are gaining attention. One such potential risk is the emergence of cheap AI, particularly from China. If true, it could disrupt current market valuations and investment strategies, particularly in the tech sector. While skepticism exists about its authenticity and adoption by Western firms, the possibility of domestic replication cannot be ignored. Market concerns extend beyond AI, with structural vulnerabilities that could exacerbate volatility. The widespread use of ODTE, 0 days to expiration, and weekly options on major tech stocks leverage ETFs like TQQQ, and the concentration of market value in few tech names presents significant risks. The NASDAQ 100, down nearly 4%, may be facing a pivotal moment if the AI narrative shifts. Additionally, the interconnected nature of Bitcoin and tech stocks through vehicles like MSTR adds another layer of risk. Further complicating market stability are geopolitical factors such as President Trump's sudden imposition of tariffs on Colombia, highlighting an unpredictable policy environment. While not a primary concern currently, such moves contribute to market uncertainty. Despite concerns, some investors view the current pullback as a buying opportunity, anticipating that AI-driven volatility will subside. However, if the claims about cheap AI prove accurate, it could trigger a paradigm shift similar to the rise of ChatGPT, potentially with negative consequences for stock valuations. Ultimately, while the market awaits confirmation on these AI developments, structural market vulnerabilities and geopolitical uncertainties remain pressing concerns, requiring investors to tread cautiously in the evolving landscape. All right. Good stuff. I know. All right. One last article here. This is the Monday Morning Outlook from Mr. Brian Westbury at First Trust. This week's article is titled Growth Continued in Q4. The likelihood of a recession remains higher than most investors anticipate as monetary policy tightening since 2022 continues to impact the economy. Inflation remains above the Federal Reserve's 2% target, making it unlikely that the Fed will loosen policy soon. Additionally, federal budget deficits have averaged 6.5% of GDP over the past 2 years, temporarily masking economic pain from higher interest rates. Reducing government spending, particularly on programs like green energy and Medicaid, could further slow growth in the short term. Let's see here. Despite these concerns, the U.S. economy grew in the fourth quarter of 2024, driven primarily by consumer spending. Real GDP is estimated to have expanded at 2.8% annual rate, with the consumption adding most to the growth. Auto sales soared 26.4% annual rate, while inflation-adjusted retail sales, excluding autos, rose at a modest 1.2%. Services spending also grew at 2.3% pace, leading in overall consumer spending contribution of 2.1% percentage points to GDP. Business investment is estimated to have grown at 2.9% annual rate, with gains in intellectual property and modest increases in equipment and commercial construction. This sector contributed 0.4 percentage points to GDP growth. Residential construction expanded at a 2.5% pace, adding 0.1 points, while directed government spending on goods and services rose at 2.3%, contributing 0.4 points. Trade had a neutral impact on GDP as imports and exports remained stable. However, slower inventory accumulation slightly subtracted from growth, reducing GDP by 0.2 points. While the economy continues to expand, it faces significant headwinds. A recession has not yet materialized, but the longer-term effects of monetary tightening and potential reductions in government spending remain concerns for future economic stability. It's out there, folks. There is a hurricane headed towards, the domestic, U.S. economy. It's headed this way. We just don't know when it's going to make landfall. Could it be next week? Could it be in 6 months? I don't know. But we, postponed that storm for 4 years, or well, I guess 5 years now, after all that money printing back in 20 and 21, for COVID. And, so now, we've got to deal with it. There's no, they could print more money and flood it into the economy and everyone thinks everything is fine. But the consequence of that is that we've just experienced 4 years of inflation and, increased the money stock by 40%. We've seen all the consequences of that. So I don't know if that's the right solution. What I would do is I would just slash and burn government spending, start paying down the federal debt. And then, once it's paid off, decentralize the union, let the states just go as they may. All right. Well, that's everything that I had to cover for today. If anyone needs anything from me, please go to, wait for it, DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a buzz. I'd be happy to help. All right. Well, I hope everyone out there has a wonderful evening, and I'll talk to everyone again next time. Adios.